everybody, Freedom family, Freedom fans. Got Tina with us. Tina, me, and CJ with you
Hey
today.
guys.
We're talking about how to present yourself in the best light to lenders, how to make yourself more attractive to different lenders, and um, you know, improve your chances of getting the best rate, right?
Yeah.
Okay, so briefly, we will kind of hit on some points and just kind of share our thoughts about it. Credit scores. How important do you think credit scores are?
Yeah,
Okay.
so this is something where you have to hit that minimum threshold for almost all large lenders. And that can range anywhere, typically you're not going to be approved for anything under around 640 to 580. That's kind of the breaking point. And if you're below that, then it's going to be really difficult to get approved. So you want to the safe zone is to have that credit score above 640.
Yeah, it's kind of their first little stopping point, their first hurdle that you have to cross.
Yep.
Okay, employment and income stability.
Yeah, so a lot of lenders will require 2 years of the same profession of work. The only time that this is maybe a little more flexible is if you are coming out from college or undergraduate, they would maybe assist in if your major was the same as your employment, same type of industry, they will
Hmm.
count that to allow you to purchase a home
Oh,
in many
that's a good
cases. But
point. I
yep.
didn't know that. That's
And
good.
and one other thing I would say is traditionally self-employed, it's much more difficult to get approved for loans, and they're going to take a average of the last 2-3 years of your income
Hmm.
to determine what your lending amount would be.
Right, they're looking for history, that
Exactly.
stability. Yeah.
Hmm.
Okay. Debt to income ratio. And I'm going through these really quickly because this is for the vlog. So
Yeah. Yeah, the
we'll
debt to
go a
income
little bit deeper dive for the podcast.
of
Debt
course.
to
So
income ratio.
yeah, so they're looking for where you're going to how well you're going to be able to pay off the mortgage each month. And so a typical debt to income that the lender is looking for is going to be around 35%, probably no more than 40%. So if you're making $5,000 gross a month, and it's a 40%, they're not going to let your mortgage payment be over $2,000 a month, right?
Mm-hmm.
And that will be in summation of all the debts you have to pay. So if you have student loans, credit cards, they're going to take that into account for those monthly payments. Again, when we're thinking about lenders, they want the safest people who are going to pay back
Yeah.
the loan, and that's what all these different factors account for: is how stable and predictable, based on the aggregate population, will this person be able to repay the loan.
Yeah. And kind of feeding into that, a couple of these next ones are your cash reserves. So again, lending to how safe a bet are you, right, for the lender. So they want to make sure you have cash on hand, and then down payment. How much are you putting down? How much skin do you have in the game? Uh,
Right.
if you only if you don't put any money in, then how likely how tied to you, how tied to the loan or
Right. And this is where it varies a little bit from an investment property versus a personal residence. So for investment properties, typically they're going to require 25% or 20% down payments.
yeah,
Whereas if it's an owner occupied place, there are programs as low as 0 and 3.5% down. But
right.
many of those you will then have to pay a private mortgage insurance, or PMI, which is a certain percentage of the loan
Hmm.
that you have to pay monthly. And that just goes to covering for those people who do, end up not repaying the loan.
Yeah, to cover them,
Exactly.
mitigate that
Exactly.
risk.
Because it's a lot more
Uh,
risk, right? If you only have 3% in and the market downturns and they need to sell the property with 20% down, they're probably still going to make money or make their money back. But if
right.
it's such a small amount, it's going to be a little more difficult.
What is the threshold where you can have that drop off? Like after you pay down or have X amount of equity, what is it, like 30% or something like that, right? Where you
It'll be in some conventional mortgages, it'll be 20%. So once you hit that 20% in equity, you would, so either it would be debt pay down or you would get the property reappraised, then it would
Yeah.
be able to drop off that PMI.
Do you have to ask for it to be dropped off, or will it automatically be dropped off?
I think you have to ask.
Yeah,
I'm not 100% on that, and it
I
also
think
may
so too.
depend on the lender as
Yeah.
well.
Yep. So just to be safe, always ask.
Yeah,
Once you hit that mark, that way you can save yourself a little bit of
right, right.
little money
Whereas,
on
like,
that.
I have a property that I purchased with an FHA loan, and the PMI will never be dropped off unless I were to refinance into a different
Refinance.
loan product,
Yeah.
even though I have that 20% equity in the property now.
Right. It's just built in. It's just part of the package, part of
Yeah.
the for that loan type. Okay. And then the last point was finding the best mortgage rate. I think that's pretty straightforward. Just do shop around. Don't just, do some research, spend some time on it, and look at all factors, of course. But in order to find the best mortgage rate, you're going to have to shop around and look at different
Yeah.
lenders. Don't sleep on credit unions either. A lot of them will not charge you a penalty fee for early prepayment. And then also local banks,
Yeah. Yeah,
just
I
do
think
some.
that's it. Especially if some of the factors that we brought up may be a little different to you, maybe your employment situation. Um, those are a lot of the requirements of the big national banks that a lot of banks will then sell your mortgage. And
Right,
that's why there's very strict guidelines and there's not much flexibility. But what you mentioned,
right,
credit unions, local banks, they are normally keeping your loan in house and therefore they can be a little bit more flexible on terms.
mm-hmm,
And that's where there's an advantage to them, right? Maybe they do have a little bit higher interest rate potentially, but maybe you're not having to put as much money down, right? So there's all sorts. So exactly what you said, shop, have those conversations. And, the best time to do it is when you don't need that
right,
mortgage the next week, right? To lock
right,
in. So
right,
I'm going through the home buying process right now. So we had kind of casually had conversations, but then we had a property we wanted to make an offer on, and we're like calling banks, like, "Hey, can you do this
right,
type of loan?" And it's a stressful situation, right? So you want to be as prepared as possible.
right. Start early.
Yeah,
Okay, great. Thank you. That's vlog number 78. Uh, Make sure you do all the clicking and the liking and the commenting.
right.
If you feel like we're bringing you any value, and we just hit those quick bullet points for you. Hopefully, you got a couple of good nuggets of information to walk away with. All right. Thanks, everybody. Okay. Bye.
Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions and information on this show are not guaranteed. All investment strategies have the potential for profit or loss.